You're broke because you think investing is a game, and you're playing it like a child. 99% of you are gambling with your rent money and calling it a strategy. If you want to stay average, keep scrolling. But if you're tired of losing, pay attention. We are ranking the 7 tiers of wealth, from the trash that keeps you poor to the strategies used by the top 1%. Most people fail because they listen to everyone. Index funds, dividend stocks, real estate. You're confused, and confusion is the fastest way to stay broke. Today, we fix that. Stop guessing. Hope is not a strategy. It's a death sentence for your capital. Tier 7. Stock picking without an edge. This is the bottom of the food chain. You buy Tesla or Nvidia because you feel like they'll go up. That's not investing. That's a trip to the casino. Unless you have an edge, meaning you understand the business, the numbers, and the competition better than the market. You are just a liquidity provider for the professionals. Think you're special? In 2025, 79% of professional fund managers, people paid millions to do this, failed to beat the S&P 500. If they can't do it, what makes you think your gut feeling is worth a cent? One bad pick, and your entire portfolio is incinerated. Tier 6. Market timing. This is the height of arrogance. You think you can sell before the crash and buy at the bottom. The market is a meat grinder. If you missed just the 10 best days of the S&P 500 between 1996 and 2025, your returns were cut in half. Miss the 30 best days? Your returns are down 84%. The best days usually happen right after the worst days. If you're scared and sitting in cash, you are missing the bounce that builds empires. Market timing requires you to be right twice. When to leave and when to come back. Most of you can't even get one right. This is for traders with systems, not for people who get emotional when they see red. Tier 5. Dividend investing. Now we're talking about cash flow, money that actually lands in your account. From 1973 to 2024, dividends made up 34% of the total return of the S&P 500. It feels real, because it is real. But here's the cold truth. Dividends aren't free money. When a company pays you, that value leaves the business. If you're chasing a 12% yield, you're probably walking into a trap. You need a $10,000 portfolio just to make about $400 a year. That's not freedom. That's a nice dinner. Consistency is the only cheat code that actually works. Stop looking for shortcuts. Tier 4. Dollar cost averaging into index funds. This is the survivor strategy. You stop trying to be clever and start being consistent. You invest a percentage of every paycheck, regardless of what the news says. Over 30 years, U.S. stocks have averaged a 10.1% annual return. It's boring. You won't feel like a financial genius, but it's the first strategy on this list that actually survives real life. Tier 3. Value investing. This is where the big players operate. You aren't buying tickers. You're buying assets for less than they're really worth. This requires an advantage, either better information or better liquidity. You see value where others see trash. Or you have the cash to close a deal when everyone else is desperate, like a divorce or a debt crisis. You make your money when you buy, not when you sell. Value investing gives you a cushion, even if things don't go perfectly. The discount you got at the start protects you. But remember, cheap doesn't always mean good. Sometimes a house is discounted because the foundation is rotted. Tier 2. Asset allocation. This is how the rich stay rich. They don't ask, "What should I buy?" They ask, "What should my money be built to do?" They balance stocks for growth, bonds for stability, cash for opportunity. It's about building a machine that can survive any weather. Do you want to be right? Or do you want to be rich? Because the pros choose being rich. Every single time. Tier 1. Owner-operator. Active capital allocation. This is the pinnacle. The top 10% of the wealthiest households in the US own the vast majority of private business equity. Why? Because they have control. When you buy an index fund, you can't call Apple and tell them to fix their margins. You just wait. With active capital, you are the driver. You buy a business and improve it. You buy a rental property and renovate it. You raise prices, cut costs, build systems. This is harder and riskier. But investing in things you actually control will always be the best investment you can make. I've given you the map. Most of you will ignore it and go back to checking your $500 crypto portfolio, hoping for a miracle. The question isn't which strategy is best. The question is, are you disciplined enough to pick one and master it? Or are you going to keep trying things until you're 60 and broke? Stop looking for the secret. Start building the machine. If this hit different, you already know what to do.